The average American overpays $5,000 in taxes every year, while the wealthy use completely legal strategies to slash their tax bills by 30 to 50%. I paid over $42,000 in taxes last year before discovering these techniques. In the next 15 minutes, I'm going to show you exactly how the wealthy legally pay less in taxes and how you can too, regardless of your income level. These aren't shady loopholes or offshore accounts. They're 100% legal strategies that the IRS actually encourages you to use. The $5,000 tax mistake you're making every year. Did you know the average American is leaving $5,000 on the table each year in overpaid taxes? That's money that could be in your pocket. Here's something most financial advisors won't tell you. The tax system isn't designed to be fair. It's designed to incentivize specific behaviors. The government essentially created a rulebook that rewards certain activities with tax breaks. The wealthy know this rulebook inside and out, while most Americans are playing the game without even knowing the rules exist. Think about it. When was the last time you sat down and strategically planned how to reduce your tax bill? If you're like most people, you probably just gather your W-2s and receipts each April, hoping for a refund. That's tax preparation, not tax planning, and it's costing you thousands. Let's get real about the numbers. According to IRS data, the wealthiest Americans consistently pay a lower effective tax rate than many middle-class workers. In 2018, the 400 richest American families paid an average effective tax rate of just 23%, while many teachers, nurses, and firefighters paid 24% or more. This isn't because the wealthy are breaking rules, they're just using the rules better than everyone else. Take Sarah, for example, a marketing consultant making $85,000 a year. For years, she filed her taxes the standard way, taking the default deductions, claiming her home office the basic way, and treating her business income like regular income. After working with a tax strategist, she restructured her business, optimized her retirement contributions, and properly documented her legitimate business expenses. The result? She paid $4,700 less in taxes the very next year, without doing anything sketchy or illegal. Or consider Mike and Jenny, a couple earning $120,000 combined. They'd been filing their taxes the same way for a decade, until a friend recommended they look into tax planning. By implementing just 3 strategies, optimizing their business structure, properly claiming home office deductions, and employing their teenage children in their family business, they reduced their tax bill by $6,800 annually. Here's the crazy part. The IRS isn't trying to hide these strategies from you. The tax code itself is designed with these incentives built in. When you claim legitimate deductions and credits, you're not exploiting loopholes. You're following the system exactly as intended. The government uses tax incentives to encourage behaviors like investing, home ownership, business formation, and retirement saving. Most Americans treat taxes like a mandatory fee they can't control, but that's just not true. There's a massive difference between tax evasion, illegal, and tax avoidance, completely legal. Tax evasion means hiding income or providing false information. Tax avoidance means legally structuring your financial affairs to minimize your tax burden, exactly what the wealthy have been doing for decades. The major distinction between average taxpayers and the wealthy isn't just income, it's mindset. Wealthy individuals see taxes as a manageable expense that can be optimized, while most people see taxes as an unavoidable burden they have no control over. Consider this reality check. If you wait until March or April to think about your taxes, you've already lost. By that point, the tax year is over and most of your strategic options are off the table. The wealthy approach taxes differently. They make tax-optimized decisions throughout the entire year, consulting with tax professionals quarterly or even monthly. Over the next sections of this video, I'm going to walk you through 5 powerful strategies that can dramatically reduce your tax bill. First, we'll look at business structure magic. How choosing the right entity type like an LLC or S corporation can immediately cut your tax bill by 30% if you're self-employed. Second, we'll explore real estate tax advantages that allow investors to show paper losses while actually making money, completely legally. Third, I'll show you retirement account secrets that go far beyond your basic 401k, allowing you to shield much more income from taxes each year. Fourth, we'll discuss how to turn market downturns into tax wins through a strategy called tax loss harvesting. And finally, we'll cover family tax planning, how hiring your family members can create massive tax savings while keeping money in your household. The best part? You don't need to be a millionaire to use these strategies. Most of them start working effectively for people earning $50,000 or more per year. These aren't exotic, complicated tactics reserved for the ultra-wealthy. They're accessible approaches that millions of Americans could be using right now. Many people worry that tax planning sounds complicated or expensive. The truth is, implementing even one of these strategies could save you thousands, far more than any costs associated with proper planning. And while some strategies do require professional help, others are simple enough to implement yourself with the right guidance. Think of it this way. If you knew you could save $5,000 this year by spending a few hours learning and implementing these strategies, wouldn't that be worth your time? That's a return of potentially thousands of dollars per hour of effort. What's most important to understand is that these strategies aren't about finding obscure loopholes or operating in gray areas. They're about understanding the incentives built into our tax system and organizing your finances to take advantage of them, just like the wealthy have been doing all along. The difference between paying too much in taxes and keeping more of your hard-earned money often comes down to knowledge and planning. While your neighbor might brag about getting a big tax refund, financially savvy people know that a refund just means you gave the government an interest-free loan all year. The goal isn't a bigger refund, it's a smaller tax bill overall. One common misconception is that tax planning requires complex financial arrangements only available to the rich. The reality is that many powerful tax strategies are accessible to everyday Americans. They just aren't widely taught or discussed. Your typical tax preparer is focused on accurately filing last year's taxes, not strategically planning to minimize next year's bill. What's standing between you and thousands in tax savings? Often, it's just information and action. The wealthy don't have access to a different tax code. They just use the same code more effectively. And that's exactly what we're about to help you do. Business structure magic. How LLCs and S-corps can cut your tax bill in half. While the wealthy don't have access to a different tax code, they do have a secret weapon that cuts their tax bills nearly in half, and it's hiding in plain sight. That secret? Structuring their businesses strategically. If you're self-employed and haven't optimized your business entity, you're essentially writing the IRS a bonus check every single year. Let's talk about self-employment taxes, because this is where the real pain happens for entrepreneurs and side hustlers. Currently, self-employment taxes sit at a hefty 15.3% of your business profits. That's 12.4% for Social Security and 2.9% for Medicare. The kicker? This tax applies to all of your business profits when you're a sole proprietor, not just a portion. Think about that for a second. If you're making $100,000 in your business as a sole proprietor, you're paying $15,300 just in self-employment taxes before we even talk about income tax. Ouch! Now let's compare that to someone making the exact same $100,000 but operating as an S-corporation. Here's where it gets interesting. With an S-corp, you're required to pay yourself a reasonable salary for the work you do. Let's say that's $60,000 in this case. You'll pay FICA taxes, essentially the same as self-employment taxes, on that $60,000, which comes to about $9,180. But here's the magic. The remaining $40,000 can be taken as a distribution, which isn't subject to self-employment taxes at all. That means instead of paying $15,300 in self-employment taxes, you're paying just $9,180. That's a savings of $6,120 in 1 year alone. The strategy works because of how S-corporations are taxed. Unlike sole proprietorships where all business income is considered self-employment income, S-corps separate owner compensation from business profits. You still pay income tax on all the money, but the self-employment tax only applies to your salary. Let me walk you through a real-world example with specific numbers. Imagine a consultant making $120,000 per year. As a sole proprietor, they'd pay self-employment tax on the entire amount. That's about $18,360 in SE taxes. But if they switch to an S-corp and pay themselves a reasonable salary of $70,000, they'd only pay about $10,710 in FICA taxes on that salary. The remaining $50,000 comes to them as a distribution without any self-employment tax. That's a tax savings of around $7,400 in a single year, just by filing one form with the IRS. And before you ask, yes, this is completely legal. The IRS explicitly allows this structure. The key phrase is reasonable salary. You can't pay yourself $10,000 when you should be making $80,000 for your role. The salary needs to reflect what you'd pay someone else to do your job. So how do you actually make this happen? The process is simpler than most people think. To elect S-corp status, you file IRS Form 2553. All shareholders must consent to the election, and your business needs to meet certain requirements, like having no more than 100 shareholders and only one class of stock. You might be wondering if there's a minimum income threshold where this makes sense. While there's no official number, most tax professionals suggest that businesses making at least $50,000 to $60,000 in profit will see enough savings to offset the additional costs of running an S-corp. Speaking of costs, this is where people often get intimidated. There are some additional expenses: state filing fees, possibly legal fees for drafting bylaws and operating agreements, and ongoing compliance costs like annual reports and payroll processing. But these typically range from $1,000 to $3,000 annually, a fraction of what you'll save in taxes. Another common misconception is that setting up these structures is complicated. While there is some paperwork involved, it's nothing that a competent accountant or attorney can't handle quickly. The ongoing maintenance is also manageable, mainly regular payroll processing and a few additional tax forms. What about LLCs? They offer flexibility for businesses with multiple owners who contribute differently to the business. An LLC can actually elect to be taxed as an S-corp, giving you both the liability protection of an LLC and the tax benefits of an S-corp. It's like getting the best of both worlds. The truly surprising part? A significant percentage of eligible self-employed individuals never take advantage of this strategy. They continue overpaying taxes year after year, even though a simple business structure change could save them thousands. Remember, this is just the first strategy we're covering. The tax savings get even more impressive when you combine this with other techniques we'll discuss later. Many wealthy individuals stack multiple strategies together for maximum tax efficiency. One important note: timing matters with this strategy. You generally need to file for S-corp status within 75 days of starting your business, or within 75 days of the beginning of the tax year to have it apply for that year. Miss this window, and you'll have to wait until the following year to implement the strategy. Let's go back to our example of the consultant saving $7,400 annually. Over 10 years, that's $74,000 in tax savings. What could you do with an extra $74,000? That could be a down payment on a rental property, fully funding your child's college education, or a significant boost to your retirement savings. So what business structure could cut your self-employment taxes in half? An S-corporation can save self-employed individuals thousands by allowing them to pay themselves a reasonable salary and take the rest as distributions that aren't subject to those hefty 15.3% self-employment taxes. Real estate tax magic. How paper losses create real wealth. If you thought saving on self-employment taxes was impressive, wait until you see how real estate investors can actually report losses to the IRS while pocketing thousands in rental income. It's the ultimate tax paradox. The more valuable your property becomes, the bigger your paper losses can grow, completely legally, of course. Let me introduce you to depreciation, the secret tax weapon that real estate investors have been using for decades. Imagine owning a rental property that puts $1,000 in your pocket every month. That's $12,000 a year in positive cash flow. But here's the magic. On your tax return, this profitable investment might actually show up as a loss. How is this possible? The IRS understands that buildings wear down over time, so they allow property owners to deduct the cost of their building, not the land, over a specific period. For residential rental properties, that period is 27.5 years. This deduction happens whether the property is actually decreasing in value or not. In fact, most properties increase in value over time. Let's walk through a real example. Say you purchase a rental property for $300,000. The IRS allows you to divide that purchase price by 27.5 years, giving you an annual depreciation deduction of about $10,909. That's nearly $11,000 you can deduct from your rental income each year, even though you haven't actually spent that money. So if your property generates $12,000 in rental income after expenses, but you get to deduct $10,909 in depreciation, you're only paying taxes on $1,091 of income, despite having $12,000 more in your bank account. That's already impressive, but it gets better. What if I told you that nearly 70% of property owners are missing out on an even more powerful depreciation strategy? This is where cost segregation studies come into play. Instead of depreciating your entire property over 27.5 years, these studies identify specific components of your property that can be depreciated much faster. Appliances, carpeting, some fixtures, and certain improvements might qualify for 5, 7, or 15-year depreciation schedules instead. This accelerated depreciation front-loads your tax deductions, creating even larger paper losses in the early years of ownership when you might need the cash flow most. For instance, a cost segregation study might determine that $100,000 of your $300,000 property consists of components that can be depreciated over just 5 years. That's $20,000 in annual depreciation for those components alone, plus the regular depreciation on the remaining $200,000. Your paper loss just got much bigger, potentially wiping out all taxable income from the property and possibly even offsetting some of your other income, depending on your specific tax situation. But wait, 2024 brings an even more powerful tool to the table: bonus depreciation. This year, the bonus depreciation rate sits at 60%, meaning you can deduct that percentage of qualifying property costs in the first year. If you purchase a $500,000 property and $150,000 qualifies for bonus depreciation, you could potentially deduct $90,000 in year one. That's in addition to the regular depreciation on the rest of the property. Think about what this means. Your property is generating positive monthly cash flow. Its market value might even be appreciating, yet on paper, you're showing significant losses that reduce your tax bill. This is precisely how many wealthy real estate investors can show losses on their tax returns while their net worth continues to climb. But what happens when you eventually sell the property and make a profit? Won't you have to pay taxes then? Not necessarily, and this is where the strategy gets truly powerful. Enter the 1031 exchange, named after Section 1031 of the tax code. This provision allows you to sell an investment property and roll the proceeds into another like-kind property without paying capital gains taxes at the time of sale. The tax is deferred until you eventually sell without doing another 1031 exchange. Here's how it works. You sell your property that has appreciated significantly in value. Instead of taking the proceeds directly, you work with a qualified intermediary who holds the funds. Within 45 days, you identify potential replacement properties, and within 180 days, you complete the purchase of your new property. By following these steps, you can defer paying capital gains taxes indefinitely. Many investors do this repeatedly, continually upgrading to larger properties, generating more rental income, and taking larger depreciation deductions, all while deferring taxes on their gains. Some investors even hold these properties until they pass away. When this happens, their heirs receive what's called a stepped-up basis, meaning the property's cost basis is reset to its current market value. If the heirs sell immediately, they might pay little to no capital gains tax, effectively eliminating the deferred tax liability altogether. This strategy becomes even more powerful when you consider the additional tax benefits of rental property improvements. When you add a new roof, upgrade the HVAC system, or make other significant improvements, these aren't just one-time expenses. They become additional depreciation deductions spread over their useful life. The most sophisticated real estate investors understand that these benefits compound over time. Each property might start with standard depreciation, then benefit from cost segregation, bonus depreciation on improvements, and eventually a 1031 exchange into a larger property where the cycle begins again. Another little-known benefit is the 20% qualified business income deduction. Real estate investing often qualifies as a business, allowing investors to deduct an additional 20% of their qualified business income. This deduction, introduced in the Tax Cuts and Jobs Act, is currently set to expire in 2025 unless renewed, making now an especially advantageous time to implement these strategies. Let's be clear, these aren't secretive loopholes or tax dodges. These provisions exist in the tax code specifically to encourage investment in real estate, which provides housing and contributes to economic growth. The government has intentionally created these incentives. They want people to invest in real estate, and they're willing to provide significant tax benefits to those who do. So how might these strategies look for someone just getting started? Imagine you purchase a $250,000 rental property that generates $2,000 monthly in rent. After mortgage, insurance, maintenance, and other expenses, you're left with $500 monthly positive cash flow or $6,000 annually. With a basic depreciation deduction of about $9,090 per year, you're already showing a $3,090 paper loss on a property that actually put $6,000 in your pocket. Add in a cost segregation study that accelerates some depreciation, and your paper loss might grow to $7,000 or more, all while your bank account grew by $6,000 and your property potentially appreciated in value. Retirement account secrets, the tax shelters most people ignore. Real estate isn't the only place where the wealthy create magic with the tax code. While most Americans max out at $23,000 in their 401k, there are completely legal retirement accounts that let you shelter up to $300,000 from taxes each year. These aren't exotic offshore accounts. They're sitting right in the tax code, waiting for you to use them. Let's quickly cover what most people already know. Traditional retirement accounts let you contribute pre-tax dollars now and pay taxes when you withdraw in retirement. Roth accounts work in reverse. You contribute after-tax money now, but enjoy tax-free growth and withdrawals later. Simple enough, right? But here's where it gets interesting. These basic accounts are just the appetizer in the tax-saving feast. The wealthy know about the main course, and it's time you did too. First up is the SEP IRA, a powerhouse for self-employed individuals and small business owners. In 2024, you can contribute up to 25% of your compensation, or $66,000, whichever is less. Compare that to the standard $23,000 limit on regular 401ks, and you're already looking at nearly 3 times more tax-advantaged space. That's a huge difference that could save you tens of thousands in taxes annually. But what if I told you $66,000 is still thinking small? Let me introduce you to cash balance plans, the retirement account strategy that high-income business owners use to shelter astronomical amounts from taxes. These plans allow contributions of over $300,000 annually, depending on your age and income. Imagine being able to reduce your taxable income by $300,000 in a single year, completely legally. Here's what's crazy. Despite these incredible benefits, statistics show that only about 13% of eligible individuals take advantage of cash balance plans. That's a massive opportunity that most people are simply walking past every day. Now, what if you're a high-income earner who makes too much to contribute to a Roth IRA directly? In 2024, the income thresholds for Roth IRA contributions phase out at $146,000 to $161,000 for single filers and $230,000 to $240,000 for married couples filing jointly. Does that mean you're out of luck? Absolutely not. Enter the backdoor Roth IRA strategy. This completely legal technique allows you to bypass those income limits by making a non-deductible contribution to a traditional IRA and then immediately converting it to a Roth IRA. The result? tax-free growth potential regardless of your income level. But wait, there's an even more powerful version called the Mega Backdoor Roth. This strategy enables you to contribute after-tax dollars to a 401k plan and then roll those funds over into a Roth IRA. The contribution limit? Up to $69,000 in 2024. That's nearly triple what most Americans think is possible to save in retirement accounts each year. Let's talk about one of the most overlooked retirement vehicles, the Health Savings Account, or HSA. Most people think of HSAs as just for medical expenses, but financially savvy individuals know they're actually the only triple tax-advantaged account in existence. You get a tax deduction when you contribute, tax-free growth while invested, and tax-free withdrawals for qualified medical expenses. In 2024, individuals can contribute $4,150 for individual coverage and $8,300 for family coverage. And here's the brilliant part. After age 65, you can withdraw the money for any purpose, paying only ordinary income tax, just like a traditional IRA. But use it for medical expenses, and it remains completely tax-free forever. Another retirement planning game changer is that the Secure Act 2.0 has eliminated the age limit for contributions to traditional IRAs. Now, individuals of any age can continue contributing as long as they have earned income, creating even more opportunities to reduce your tax burden throughout your lifetime. What I love about these strategies is how they can be stacked together for maximum impact. A high-income business owner could potentially use all of these approaches simultaneously. Max out a solo 401k or SEP IRA, implement a cash balance plan for additional tax-deferred savings, use the backdoor Roth strategy for tax-free growth, contribute the maximum to an HSA for triple tax advantages. The combination can easily shield over $400,000 from taxes annually, all while building significant retirement wealth. Let me share a quick example. Consider Dr. Rodriguez, a physician earning $400,000 annually. By implementing a comprehensive retirement strategy, she contributes $66,000 to her SEP IRA, $245,000 to her cash balance plan, $7,000 through a backdoor Roth IRA, and $8,300 to her family HSA. That's over $326,000 in tax-advantaged contributions in a single year. At her tax bracket, this saves her approximately $120,000 in taxes annually, while dramatically accelerating her path to financial independence. Or take Michael, a marketing consultant earning $150,000. While he can't contribute as much as Dr. Rodriguez, he can still utilize a solo 401k for $43,000 in contributions, combining employee and employer portions, perform a backdoor Roth IRA contribution of $7,000, and add $4,150 to his HSA. That's over $54,000 in tax-advantaged savings, more than twice what most people think is possible, saving him about $16,000 in taxes this year alone. What's particularly powerful about these retirement strategies is that unlike real estate, which requires significant capital and ongoing management, many of these retirement accounts can be started with relatively small amounts and managed with minimal ongoing effort. I want to emphasize something important. These strategies aren't about fancy accounting tricks or questionable tax shelters. They're explicitly written into the tax code because the government wants to encourage retirement savings. You're not gaming the system. You're using it exactly as intended. The biggest obstacle isn't eligibility or complexity. It's simply awareness. Most financial advisors don't proactively recommend these strategies because they require specialized knowledge. And most CPAs are focused on preparing your tax return for last year rather than planning strategies to reduce next year's taxes. So what's your next step? First, evaluate which of these retirement vehicles matches your employment situation. Self-employed? Look at CP IRAs and solo 401ks. High-income business owner? Investigate cash balance plans. Employee with a good 401k plan? Ask if your plan allows after-tax contributions to enable the Mega Backdoor Roth strategy. Second, check if you're eligible for an HSA by confirming whether your health insurance qualifies as a high-deductible health plan. If it does, opening and maxing out an HSA should be near the top of your priority list. Third, if your income exceeds the Roth IRA limits, talk to a financial advisor about implementing the backdoor Roth strategy. While the mechanic loss harvesting, turning market downturns into tax wins. Now let's talk about a strategy that most everyday investors completely miss, especially when markets take a dive. While retirement accounts give us tax-sheltered growth, what if I told you that market downturns could actually be a golden opportunity to slash your tax bill? That's right. When most people are panicking about their portfolio dropping, savvy investors are busy turning those temporary losses into real tax savings through a technique called tax loss harvesting. When you sell investments at a profit, you typically owe capital gains taxes on those profits. These taxes can take a significant bite out of your investment returns over time. Depending on your income level and how long you've held the investment, you might be paying anywhere from 0% to 37% on those gains. That's money that could otherwise be compounding in your portfolio, working for you year after year. But here's where most investors miss a huge opportunity. When the market drops and your investments are in the red, most people just sit there watching their portfolio decline, waiting, and hoping for a recovery. What they don't realize is that those paper losses can actually be converted into tax savings through strategic selling. Tax loss harvesting is exactly what it sounds like. You're harvesting your investment losses to offset gains elsewhere in your portfolio or even your regular income. Here's how it works. You sell investments that have declined in value, realizing those losses for tax purposes. You can then use those losses to offset capital gains from other investments you've sold at a profit. If your losses exceed your gains, you can even use up to $3,000 of those losses to offset your ordinary income. Let me walk you through a real example that shows just how powerful this strategy can be. Let's say you have $10,000 in capital gains from selling some winning investments this year. Without any offsetting losses, you'd pay taxes on that full $10,000. If you're in the 24% tax bracket, that's $2,400 going straight to the IRS. But what if you also have some investments that haven't performed so well? Maybe you have $10,000 in paper losses sitting in your portfolio. By selling those underperforming investments, you can use those $10,000 in losses to completely offset your $10,000 in gains. The result? You've just eliminated your tax bill on those gains, saving yourself $2,400 in taxes. That's money you get to keep and reinvest. But what about maintaining your investment strategy? After all, you might not want to permanently exit those positions. That's where understanding the wash sale rule becomes crucial. The IRS doesn't want you gaming the system by selling an investment just for the tax loss and immediately buying it back. So they implemented the wash sale rule, which prohibits you from claiming a tax deduction for a loss if you purchase the same or substantially identical security within 30 days before or after the sale. The key to working around this rule while maintaining your investment strategy is to replace the sold investment with something similar, but not substantially identical. For example, if you sell shares of an S&P 500 index fund from one provider, you could buy a different S&P 500 fund from another provider, or perhaps a total market fund that gives you similar but not identical exposure. This way, you get the tax benefit while still maintaining your overall investment allocation. What's particularly exciting about tax loss harvesting is that it's no longer just a tool for the wealthy with expensive financial advisors. Technology has democratized this strategy through automated services offered by many robo-advisors. These platforms can monitor your portfolio daily and automatically identify opportunities to harvest losses, making the whole process virtually hands-off for you. In fact, research shows that taking a daily approach to tax loss harvesting instead of only looking for opportunities monthly can yield about 30 basis points, 0.3% of additional annual tax savings. That might sound like much, but over decades of investing, it can add thousands of dollars to your nest egg. Tax loss harvesting becomes especially powerful during market downturns like the one we saw in early 2020 or during 2022. When markets fall broadly, many investments are likely to be down simultaneously, creating a perfect harvesting opportunity. While everyone else is panicking, you can be methodically capturing those losses for tax purposes, setting yourself up for significant tax savings. Another benefit of tax loss harvesting is that any losses that exceed your gains and the $3,000 ordinary income deduction don't disappear. They can be carried forward to future tax years indefinitely. This means that a significant market downturn can generate tax benefits that you might be using for years to come, even as the market recovers. Let me share a quick insight about how this might look in practice. Imagine you've been investing for several years and have a mix of winners and losers in your portfolio. During a market correction, you identify $15,000 in losses across several positions. You sell these investments, realizing the losses. You had $8,000 in capital gains this year from other investments, so you completely offset those gains. You can then use $3,000 of the remaining losses against your ordinary income, potentially saving you another $720 if you're in the 24% tax bracket. The remaining $4,000 in losses gets carried forward to next year. The best part? You've done all this without fundamentally changing your investment approach. After waiting 31 days to avoid the wash sale rule, you can reinvest in similar but not identical assets to maintain your desired allocation. Or you could immediately reinvest in different assets that still align with your investment goals. For those who don't want to manage this process themselves, many robo-advisors now offer automated tax loss harvesting as part of their service. These platforms continuously monitor your portfolio for harvesting opportunities, making small adjustments throughout the year to maximize tax efficiency. This automation has truly made tax loss harvesting accessible to everyday investors in a way that wasn't possible just a decade ago. The savings from consistent tax loss harvesting can be substantial over time. Even if you're just saving a few $1,000s in taxes each year, that's money that stays in your investment accounts, continuing to grow and compound. Over decades, this can add tens of thousands of dollars to your retirement savings. Remember, too, that tax loss harvesting works hand in hand with the other strategies we've discussed. When combined with optimized retirement accounts and business structure strategies, you're creating a comprehensive approach to tax efficiency that can dramatically improve your long-term financial outcomes. Family tax planning: how hiring your kids and parents creates massive savings. What if your biggest untapped tax asset is sitting across from you at the dinner table? The wealthy have been using family employment strategies for decades, legally shifting income from high tax brackets to zero tax brackets. And it's simpler than you might think. Let's talk about a powerful strategy that almost seems too good to be true: hiring your family members in your business. This isn't just about giving your kids some pocket money. It's about significant tax savings that can add up to thousands of dollars each year while teaching valuable life skills. Here's the genius behind this strategy: income shifting. When you're in a higher tax bracket, say 32%, and you pay yourself another $12,000 from your business, you're handing over $3,840 of that to the IRS. But what if instead you pay that $12,000 to your child who has zero taxable income? The result is dramatically different. For 2024, the standard deduction for single filers is $13,850. That means your child can earn up to this amount without paying any federal income tax at all. So that same $12,000 that would have cost you $3,840 in taxes might cost your child exactly zero in federal taxes. That's instant savings just by shifting who receives the income. But wait, it gets even better. If you have the right business structure, you don't have to pay Social Security or Medicare taxes on wages paid to your children under 18. With the combined 15.3% FICA tax rate, that's another $1,836 in savings on that $12,000 salary. Add these savings together, and you're looking at over $5,600 in tax savings just by paying one child a legitimate salary. Let me share a real example. The Johnsons own a small marketing agency and are in the 32% tax bracket. Last year, they hired both their children, ages 14 and 16, and paid them each $12,000 for legitimate work. Their daughter helped with social media management and content creation, while their son assisted with administrative tasks and basic graphic design. By shifting $24,000 of business income to their children, they saved $7,680 in income taxes, plus an additional $3,672 in FICA taxes. That's a total tax savings of $11,352 in a single year. Now, before you run off to put your toddler on the payroll, there are some important rules you need to follow. The IRS isn't stupid, and they've seen every trick in the book. First and foremost, the work must be legitimate and age-appropriate. Your 7-year-old probably shouldn't be your CFO, but they could model for your business's advertising materials, stuff envelopes, or help with simple filing. Documentation is absolutely crucial. You need to treat your children like any other employee. This means 1. Completing all necessary payroll forms, including W-4s and I-9s. 2. Creating detailed job descriptions outlining responsibilities. 3. Tracking work hours with timesheets or time tracking software. 4. Paying reasonable wages that match what you'd pay anyone else for the same work. 5. Issuing regular paychecks and properly withholding taxes when required. 6. Filing all appropriate tax forms, including W-2s at year-end. The wages must also be reasonable for the child's age and the work performed. Paying your 10-year-old $50 an hour to clean the office once a week will raise red flags. Pay market rates for the work being done, and make sure you have documentation to back it up. You also need to actually pay your child. The money should go into a bank account in their name, though you can be a custodian if they're minors. Don't just move the money on paper. Actual transfers need to happen. What kinds of work can your children legitimately do? More than you might think. For teenagers, this could include managing social media accounts, content creation for blogs or websites, basic administrative tasks, data entry and filing, cleaning the office, inventory management, customer service. For younger children, consider modeling for advertising materials, simple cleaning tasks, basic filing and organization, envelope stuffing, product testing for age-appropriate products. What's fascinating is that despite these significant tax advantages, many eligible business owners fail to implement this strategy. Studies indicate this is often due to a simple lack of awareness or misunderstanding of the rules. That's money being left on the table year after year. Now, this strategy isn't just limited to your children. You can also hire your spouse or parents in your business, though the tax advantages work differently. With spouses, you might gain access to additional retirement plan contributions or healthcare benefits. With parents who are retired or in lower tax brackets, you can shift income their way while potentially helping them supplement their retirement income. Imagine combining this family employment strategy with the S-corporation structure we discussed earlier. As an S-corp owner, you're already saving on self-employment taxes for distributions above your reasonable salary. By also employing your children, you're creating a double tax advantage, reducing both your income and self-employment tax burdens simultaneously. Even better, this strategy offers benefits beyond just tax savings. You're teaching your children valuable skills about work ethic, financial responsibility, and business operations. They're gaining real-world experience that will serve them well throughout their lives. Many successful entrepreneurs credit their early exposure to business through working in family operations as foundational to their later success. Consider starting your children with a custodial Roth IRA where they can invest some of their earnings. Since they're likely in a zero tax bracket, they're essentially getting tax-free growth for life. A child who invests just $6,000 a year from ages 14 to 18 could have over $1 million by retirement age, assuming historical market returns. That's setting them up for financial success while saving you money on taxes today. The overlooked deductions costing you thousands each year. Beyond family tax planning lies a treasure trove of deductions that even financially savvy people overlook. What if I told you that the government has essentially written you a $3,500 check that's just sitting there unclaimed? The wealthy aren't just creating strategic tax structures, they're obsessive about capturing every deduction the tax code allows. Tax deductions are like finding money in the government's couch cushions. They're there for you to claim, completely legal, and explicitly designed to reduce your tax burden. But Here's what most people don't realize. These deductions aren't optional suggestions. They're built into the tax code specifically because the government wants to incentivize certain behaviors and expenses. Yet according to tax professionals, the average taxpayer misses thousands in legitimate deductions every single year. It's not about gaming the system. It's about not leaving money on the table that's rightfully yours. Let's uncover the most commonly overlooked deductions that could be slashing your tax bill right now. First up, the home office deduction. If you've been working from home, and who hasn't these days, you might be sitting in your biggest untapped tax break. There are two methods to calculate this deduction, and choosing the wrong one could cost you serious money. The simplified method lets you deduct $5 per square foot of home used for business, up to 300 square feet. That means a maximum deduction of $1,500. Easy, right? But here's where most people mess up. The regular method could potentially give you a much larger deduction. With the regular method, you calculate the percentage of your home used for business and apply that to your actual expenses: mortgage interest, insurance, utilities, repairs, and even depreciation. For many homeowners, this method can yield deductions 2 or 3 times larger than the simplified option. Let me paint a picture. Sarah has a 2,000 square foot home with a 200 square foot office, 10% of her home. Her annual housing costs, including mortgage interest, property taxes, utilities, and insurance, total $30,000. Using the simplified method, she'd get a $1,000 deduction, 200 square feet, and $5. But with the regular method, she could deduct $3,000, 10% of $30,000. That's an additional $2,000 in deductions just by doing some simple math. Vehicle deductions are another goldmine that most taxpayers completely miss. The IRS gives you 2 options here as well: the standard mileage rate or actual expenses. For 2024, the standard rate is 65.5 cents per mile driven for business purposes. That means if you drive just 100 miles a week for business, you're looking at a $3,406 deduction over the year. But depending on your vehicle and circumstances, tracking actual expenses might yield an even bigger deduction. This includes gas, repairs, insurance, and depreciation. If you drive a larger or more expensive vehicle, this method often wins out. The key to maximizing vehicle deductions is meticulous tracking. A simple mileage app on your phone can document every business trip, turning your car into a tax-saving machine. Yet most people don't bother with consistent tracking and end up guessing at tax time. A major red flag for auditors and a guaranteed way to leave money on the table. Healthcare costs represent another massive opportunity for tax savings. Health savings accounts, HSAs, are perhaps the most underutilized tax break in America. They offer a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. For 2024, individuals can contribute up to $4,150 to an HSA, while families can contribute up to $8,300. If you're 55 or older, you can add another $1,000 in catch-up contributions. That's over $8,000 that could be completely shielded from taxes for a family. Yet most eligible people don't come close to maxing out these accounts. Beyond HSAs, many people don't realize they can deduct medical expenses that exceed 7.5% of their adjusted gross income. This includes costs that insurance doesn't cover: dental work, vision care, specialized treatments, and even certain home modifications for medical conditions. Education-related tax breaks are frequently missed as well. The student loan interest deduction allows you to deduct up to $2,500 of interest paid on qualified student loans. What makes this deduction particularly valuable is that you don't need to itemize to claim it. It's an above-the-line deduction available to anyone who qualifies. Then there are education credits like the American Opportunity Credit, up to $2,500 per eligible student, and the Lifetime Learning Credit, up to $2,000 per tax return. These credits directly reduce your tax bill dollar for dollar, not just your taxable income. Yet millions of eligible taxpayers fail to claim these every year. What turns these overlooked deductions from merely helpful to truly powerful is when you combine them with the strategies we've already discussed. Imagine running your business as an S corporation. implementing smart real estate investments, maximizing retirement accounts, and capturing all these additional deductions. The compound effect can reduce your effective tax rate dramatically. But there's a critical element to making all this work: documentation. The IRS requires proof of all claimed deductions to validate their legitimacy. This means keeping receipts, maintaining logs of business mileage, and recording expenses related to your home office use. In the digital age, apps and cloud storage make this easier than ever, yet proper documentation remains the most common failure point for taxpayers. I recommend creating a simple system: dedicated credit cards for business expenses, automatic mileage tracking apps, and monthly receipt organization. Spending just 30 minutes a month on this documentation can protect thousands in deductions if you're ever audited. Here's what's fascinating about these deductions. They're not obscure loopholes or aggressive tax positions. They're standard, everyday deductions that the IRS fully expects taxpayers to take. The tax code isn't written to trick you. It's written to create specific incentives for behaviors the government wants to encourage. When you miss these deductions, you're actually going against the system's design. Income timing magic: how to legally shift income to lower your tax bracket. While incentives and deductions form the backbone of tax planning, there's another dimension that's just as powerful but rarely discussed: when your money counts as income. This timing element isn't about tax evasion, it's about working with the tax system exactly as designed to ensure you're not paying more than necessary. Our progressive tax system creates a fascinating opportunity that most taxpayers completely miss. When you earn money matters almost as much as how much you earn. Let me show you why. Imagine earning $90,000 in December and another $90,000 in January. On paper, that's $180,000 for the year. But here's where timing creates a massive difference. Those December earnings push you into higher tax brackets immediately, while spreading that same income evenly throughout the year would keep more of your dollars in lower brackets. The tax difference can be thousands of dollars, all because of when the money arrived in your account. This is exactly why wealthy individuals obsess over income timing. They know that controlling when money counts as taxable income can be just as valuable as maximizing deductions. It's like having a time machine for your tax dollars. For self-employed people, this creates powerful opportunities. Let's say you're finishing up client work in December. Simply by waiting until January to send that invoice, you can push the income into the next tax year. If you expect to be in a lower tax bracket next year, perhaps because you're planning to take time off or invest in business equipment, that timing decision alone could save you significant tax dollars. This isn't just theoretical. Tax professionals routinely help clients save thousands through strategic timing. By delaying income recognition when beneficial or accelerating it when advantageous, you're essentially smoothing out your tax burden across multiple years. The IRS completely expects this behavior. They've built the rules around it. But what exactly is income recognition? The IRS follows what's called the constructive receipt doctrine. This means income is taxable when you have control over it, even if you don't physically have it yet. For example, if a client offers to pay you in December, but you ask them to wait until January, the IRS still considers that December income because you could have received it then. The key is to understand and work within these rules. For self-employed individuals, this might mean 1. Sending invoices strategically at year-end based on your tax situation. 2. Bunching business expenses into whichever year gives you the best tax advantage. 3. Timing major purchases or investments to maximize deductions when you need them most. Even if you're a W-2 employee, you have options. Many companies allow you to defer bonuses until the following year. If you're expecting a $10,000 year-end bonus, but already had a great income year, asking your employer to pay it in January instead of December could potentially save you thousands in taxes, especially if it would push you into a higher bracket. You can also time your deductible expenses. Charitable contributions, medical procedures, property tax payments, these can often be shifted between December and January to maximize their tax impact. The same goes for retirement contributions, which can dramatically impact your adjusted gross income. The most powerful application of this strategy comes through what tax professionals call tax year arbitrage. This involves taking advantage of changing tax rates or laws by shifting income between years. For instance, if tax rates are scheduled to increase next year, accelerating income into the current year might make sense. Conversely, if rates will decrease, deferring income could be advantageous. Documentation is absolutely critical when implementing these strategies. You need clear records of when income was received, when invoices were sent, and any agreements regarding payment timing. Without proper documentation, the IRS may challenge your income timing decisions. Let me give you a concrete example of how powerful this can be. Consider a freelance designer who typically earns about $85,000 annually. In November, she lands a major project worth $30,000. If completed and billed in December, this would push her total income to $115,000 for the year, with a significant portion taxed at a higher rate. By negotiating with the client to split the project across tax years, billing $10,000 in December and $20,000 in January, she keeps more of her income in lower tax brackets, potentially saving thousands. What's remarkable about income timing strategies is how they compound the effectiveness of every other tax strategy we've discussed. When you combine smart income timing with business structure optimization, real estate tax benefits, retirement account strategies, and family tax planning, the results can be transformative for your financial situation. For example, a business owner using an S-corporation structure who also implements income timing can supercharge their tax savings. They're already saving on self-employment taxes through their business structure, and by carefully timing when they take distributions versus salary, they can further optimize their tax situation. Similarly, real estate investors can time property improvements and expense recognition to maximize deductions in years when they have higher income from other sources. This strategic approach to when you spend and when you earn creates a powerful tax optimization system. Here's what makes income timing so special. Unlike many tax strategies that require significant setup or investment, this approach can be implemented almost immediately with proper planning. It's like finding a tax planning superpower hiding in plain sight. But there's an important caveat. While timing strategies are perfectly legal, the IRS does watch for abusive patterns. The key distinction is legitimate business purpose. If you're delaying income recognition solely for tax reasons without any business justification, that could raise red flags. Always ensure your timing decisions have legitimate business purposes beyond tax benefits. As we enter the final quarter of the year, this is the perfect time to evaluate your income situation. Are you having a higher income year than expected? Consider deferring additional income to next year if possible. Had a down year? Implementation you might want to accelerate 30-day tax into the current year to take advantage while of the wealthy brackets. Have accountants guiding them through these tax strategies step by step. Most people are left wondering how to turn this knowledge into actual savings. Did you know that implementing just one strategic tax move per week for a month could potentially save you thousands on your next tax bill? Here's the exact 30-day roadmap that breaks down these seemingly complex strategies into manageable weekly actions. I get it. Trying to implement all these tax strategies at once feels like trying to drink from a fire hose. It's overwhelming, and that's exactly why most people never get around to actually using these powerful techniques. But here's the thing. Tax planning isn't a one-day event. It's a process that becomes incredibly manageable when broken down into weekly action steps. The clock is ticking, though. Many of these strategies have deadlines that must be met before the end of the tax year. Waiting until March or April when you're scrambling to file your return means you've already missed the boat on most of these opportunities. The wealthy don't wait until tax season. They implement these strategies year-round, and especially in the final months of the year. Before diving into any specific strategy, you need to know which ones will give you the biggest bang for your buck. This depends entirely on your unique situation. A real estate investor will benefit from different strategies than a W-2 employee with a side hustle. Your income level, employment status, and family situation all play crucial roles in determining which tax moves will save you the most money. let's break down your 30-day plan week by week with specific actions you can take right now. Week 1 is all about assessment and strategy selection. Start by gathering your financial documentation, previous tax returns, income statements, and relevant financial records. This creates a clear picture of your current tax situation and helps identify the biggest opportunities for savings. If you earned $85,000 last year but expect to make $120,000 this year, that jump in tax brackets means income timing strategies become extremely valuable. If you're self-employed with profits over $60,000, business structure optimization suddenly becomes your highest priority strategy. During this first week, create a prioritized list of the specific tax strategies that align with your situation. Don't try to implement everything. Focus on the 2 to 3 strategies that will have the largest impact on your tax bill. For most people, this assessment phase alone can identify thousands in potential tax savings that were previously overlooked. In week 2, it's time to set up the necessary business structures if applicable to your situation. This might mean filing paperwork to establish an LLC or electing S corporation status. The costs associated with forming these entities vary by state, but typically include filing fees and potential legal consultation expenses. While this might seem like a hassle, remember that the right business structure can save you thousands annually in self-employment taxes alone. This is also the time to establish proper documentation systems. Set up a method for tracking business expenses, mileage, and other deductions. This could be as simple as a dedicated app on your phone or as comprehensive as accounting software that automatically categorizes expenses. Creating these systems now prevents the mad scramble for receipts and documentation that most people experience at tax time. Week 3 focuses on implementing retirement account strategies. This is when you'll take concrete steps to maximize contributions to appropriate retirement vehicles based on your situation. For employees, this might mean adjusting your 401k contributions to hit the $23,000 limit for 2024. For those over 50, it means taking advantage of the additional $7,500 catch-up contribution. Self-employed individuals have even more options during this week. You might open a solo 401k or C-PEEP IRA to dramatically increase your tax-deferred savings. The beauty of retirement account strategies is that they not only reduce your current tax bill but also help build wealth for the future. A true win-win that the wealthy have leveraged for decades. This is also the time to make any necessary adjustments to your investment portfolio. If you haven't been tax loss harvesting throughout the year, week 3 is perfect for implementing this strategy before year-end. A quick review of your investments might reveal thousands in potential tax savings through strategic realization of paper losses. By week 4, you're ready to implement family tax planning strategies and finalize your approach with professional guidance. If you have a business, this is when you'll complete the paperwork to officially hire family members. You'll establish job descriptions, payment structures, and necessary documentation to ensure these arrangements withstand IRS scrutiny. This final week is also the time to consult with a tax professional to validate your strategy and identify any additional opportunities. While DIY tax planning can take you far, a professional review often reveals additional strategies you might have missed. The cost of professional help varies based on your situation's complexity and the advisor's expertise, but the return on investment is typically substantial. What immediate steps can you take today to start saving on taxes? Begin with that week 1 assessment. Pull out your most recent tax return and identify the areas where you're paying the most. Is it self-employment taxes, capital gains, income taxes on a higher bracket? This simple analysis will point you toward your highest impact opportunities, allowing you to implement one strategy per week for the next month. The beauty of this 30-day approach is that it transforms overwhelming tax strategies into manageable weekly actions. Each week builds on the previous one, creating a comprehensive tax plan that can save you thousands this year and every year going forward. Remember that tools like Tax Alpha can help automate parts of this process, particularly for investment-related strategies. These platforms can scan your portfolio and suggest specific sales to offset gains, making tax-efficient investing much more accessible than it was even a few years ago. The implementation timeline is crucial. Starting early in the tax year gives you room to adjust and maximize benefits before deadlines approach. Many of these strategies have specific timing requirements that must be met to qualify for the current tax year. Don't let common roadblocks derail your tax-saving journey. Misunderstanding deduction requirements, failing to maintain proper documentation, or hesitating to consult professionals when needed can cost you thousands. Each week in this plan is designed to overcome these specific obstacles. Which strategies work best for your income level? Speaking of obstacles, the biggest one might be sitting right in front of you: choosing the wrong tax strategies for your income bracket. Did you know that the optimal tax approach for someone making $80,000 is dramatically different from someone earning $250,000? That mismatch is exactly why most people never see significant tax savings. They're implementing strategies that simply don't deliver results for their specific situation. Let's be honest. Trying to implement advanced tax strategies that don't align with your income level is like buying an expensive sports car when you only need a bicycle. You're wasting resources and missing out on what would actually help you right now. The wealthy don't just use different strategies than everyone else. They use different strategies at each stage of their wealth-building journey. So let's break down exactly which tax strategies will give you the biggest bang for your buck based on your current income level. No more guesswork, no more wasted effort. If you're earning between $50,000 and $100,000, your primary focus should be maxing out your retirement accounts. The 2024 contribution limit for a 401k is $23,000, and for IRAs it's $7,000 or $8,000 if you're 50 or older. This isn't just about saving for retirement. It's about immediately reducing your taxable income and potentially dropping to a lower tax bracket. Here's something most people in this income range miss: the Saver's Credit. This gem provides a tax credit of up to $2,000 for eligible contributions to retirement accounts. That's free money just for planning for your future. If you have a side hustle or small business at this income level, hiring family members becomes incredibly powerful. Your kids can earn up to the standard deduction without paying federal income taxes, creating an instant tax-free zone for income that would otherwise be taxed at your higher rate. Plus, the money stays in the family while teaching valuable work skills. Remember, at this income level, keep it simple. Focus on strategies that directly reduce your taxable income without creating complex administrative burdens. The goal is maximum tax reduction with minimal complexity. As your income grows into the $100,000 to $250,000 range, it's time to level up your tax strategy game. This is where business structure optimization becomes crucial. If you're self-employed, an S corporation structure starts delivering serious savings at this income level. The S Corp strategy allows you to pay yourself a reasonable salary, which is subject to payroll taxes, while taking the remainder of your profits as distributions, which aren't subject to self-employment tax. The IRS does require S Corp shareholders to pay themselves a reasonable salary, but the tax savings on the distribution portion can be substantial, especially as your income climbs higher in this range. At this level, you should also be looking at more sophisticated retirement strategies. You've likely maxed out your basic accounts and can now explore options like solo 401ks that allow for higher contribution limits. Don't just contribute the employee portion, leverage the employer contribution as well to maximize your tax-advantaged savings. Real estate investments also start making significant tax sense in this income bracket. The depreciation deductions and potential for passive income can create powerful tax advantages that complement your core income. As you cross into the $250,000 to $500,000 range, your tax strategy needs to become even more sophisticated. This is where advanced retirement accounts like cash balance plans come into play. These plans allow for contributions exceeding $300,000 annually in some cases, creating massive tax deferrals while building your retirement nest egg. You should also be thinking about backdoor Roth IRA strategies at this income level, since direct contributions are phased out at much lower income levels. This approach allows you to continue building tax-free growth despite income limitations. At this income level, your tax planning should become more comprehensive, with quarterly strategy sessions rather than just annual tax prep. The stakes are simply too high to take a passive approach. Every percentage point of tax savings represents thousands of dollars. For those earning above $500,000, it's time to deploy the full arsenal of tax strategies in combination. This includes everything we've discussed, plus advanced techniques like tax loss harvesting, strategic charitable contributions, and 1031 exchanges for real estate investments. At this income level, you're likely paying the highest marginal tax rates, so sophisticated income timing strategies become crucial. Shifting income between tax years and entities can create significant savings when done strategically and with proper documentation. The power at this income level comes from combining multiple strategies that work together. It's not about finding one silver bullet, but rather implementing a coordinated approach that addresses every aspect of your tax situation. Here's the beauty of this progressive approach. As your income grows, you can layer on new strategies without abandoning what already works. The retirement account contributions that helped you at $60,000 still provide value at $600,000. You just add more sophisticated techniques on top. Think of it like building a house. You start with a solid foundation, retirement accounts and basic deductions. Add the framework, business structures and family employment. Then finish with increasingly sophisticated elements, advanced retirement plans, real estate strategies, and comprehensive income planning. The most powerful aspect of this approach is that you're never implementing strategies that don't deliver results for your specific situation. You're always focusing on the highest impact moves for your current income level, maximizing your return on time invested. So many people spend hours trying to implement tax techniques that simply won't move the needle for them. They've heard about some strategy that saved someone else thousands, but they don't realize that their income situation is completely different. Remember, tax strategy isn't one size fits all. What works brilliantly for someone making $300,000 might be completely ineffective for someone earning $75,000. By matching strategies to your income level, you ensure that every hour you spend on tax planning delivers real results. As you implement these income-appropriate strategies, don't forget to review and adjust annually. As your income changes, so should your tax approach. What worked last year might not be optimal this year if your income has significantly increased or decreased. The wealthy understand this progression instinctively. They're constantly evaluating which strategies make sense at their current income level and adjusting accordingly. They don't waste time on techniques that won't deliver meaningful results, and neither should you. Let's wrap this all up. The most powerful tax-saving strategy isn't complicated at all. It's simply taking action. By implementing just one tax optimization technique, you could keep thousands more dollars in your pocket annually. Consider a simple example. Contributing to your 401k up to the maximum allowed amount of $22,500 would immediately reduce your taxable income by that same amount. For someone earning $100,000, that single move drops your taxable income to $77,500, resulting in significant tax savings without complex planning. These strategies aren't sneaky loopholes or questionable schemes. They're purposeful incentives written directly into the tax code, designed to encourage specific financial behaviors that benefit both you and the economy. The government actually wants you to use these strategies. Your path forward is clear. Identify the approach that best fits your situation. Talk to a qualified tax professional and start reclaiming your hard-earned money today. Don't leave thousands on the table for